Okay, so Wayne, for this session, we had thought about covering three different items. The first one I wanted to attack, if you will, was Visa's earnings. I think they reported on the 28th of April, and you know, a couple things jumped out to me right away, very high level. One was the surge in volume that they recorded year over year, and the second one was the that they had bought back stock, and they had announced that they have plans to buy back additional shares of stock, which usually creates some lift or appreciation to the share price. However, just those two headlines alone, you know, perhaps explained, a rather stark lift in the stock price post earnings release. But I wanted to double click on that with you today to see if, maybe that's too easy, or that was too simplified an explanation as to why the stock really popped afterwards. And given that Visa is a bellwether of our industry, I think it's relevant to understand what's going on there. They have excellent data, especially as it relates to consumer spend, and they are a global company, so they have tentacles everywhere. They're a great proxy for what's going on in payments at any given moment. So yeah, I wanted to toss it to you as the professional analyst and ask you, is that oversimplified? Just the buybacks and the spike in volume, and in regards to the spike in volume, is that a reflection of increased energy prices as a result of what's going on in the Middle East right now?
Well, thank you for the setup on Visa. I agree. It's an important company in the space, if not one of the most important, for the reasons that you've just stated, and that trickles down to valuations and expectations for the sector as a whole, whether they should or not. It does lift the rising tide, lifted all boats, because people are feeling better about fintech and payments because of Visa's results, at least in the near term. So, number one, I think across the board beat. So it's a quality beat, and it was going to beat one way or another, and it beat for the right reasons. And so when you lead with volume and strength of U.S. consumer and strength of European transactions, particularly cross-border, which are very high margin, that's a very good place to start. And I think that there was a relief that it wasn't worse. And the stock had been treading water for over a year, up low single digits versus S&P, which was up approximately 20% in the same trailing 12-month period. So there's some catching up to do here as far as the shares go compared to the broader market. And some of the concerns that were holding the stock down was the outlook for the U.S. consumer. And we saw them grow right through those worries in the most recent quarter. So to summarize, they really fired on all cylinders across just about all of their geographies and service revenue lines. The weak spot was the Middle East because of the conflict that's going over there and the disruption that that's causing. But that represents about 6% of total revenues, and the company was able to grow right through that and around it with the strength of the other segments making up the difference and a little bit more. So that gave investors a reason to be excited about it. Secondly, on an operational basis, on a technical basis, on a share buyback basis, investors like to see the share buyback when it's augmented by strong operating results. And that's what we had here. So you had a 1-2 punch. Yes, they beat across the board. Yes, they're raising guidance. And oh, by the way, we continue to be believers that there's more to go in the stock, and we're going to buy back approximately 6% of the shares before the last financial reporting period of this fiscal year. So there was a lot to like about it in the near term. I think the trickle down effect of higher gas prices has not been fully felt yet in the U.S. Year over year, it's definitely some sticker shock. On a trailing 12-month basis, approximately $4.35 for a gallon of gas versus roughly $3.20 or so in the same period a year ago. So that is higher pricing, that is inflation. There's no question. And the bigger question is, how long is that going to last, and how high are prices going to go? So we're looking at the busiest driving season part of the year, the seasonal high point, the summer, and it's too early to know whether that's going to create demand destruction for more driving. I got to believe at the edges somewhere that it will, but if the second quarter report is an indication, they've been able to grow right through that so far. But the longer this goes on, or the higher that energy prices go, that comes into question for me longer term. But nearer term, the results were very good for all the reasons that we've just stated. And that's the reason for the excitement. So in summary, there's light at the end of the tunnel. It wasn't as bad as we thought. It grew, as they say on Wall Street, up. The company, the shares grew a wall of worry, and it crawled up a wall of worry. Performance was better than we'd hoped, and here we are.
Well, you have an interesting theory about this that you've articulated before, and it's fascinating to me because you mentioned demand destruction, but not yet. And I think what you posited before was that it's quite possible that short term, higher gas prices, and again, energy feeds into everything in the economy, basically, but higher gas prices equals higher ticket prices, and people may be switching from debit to credit because of that higher ticket price. You also posited that rewards may factor into that, but again, that transition from the debit transaction to the credit transaction, where there's more margin for Visa, may also be a short-term bump for them, or explain the short-term bump.
No question about it. So, and we wrote about this previously in our newsletter. The highest margin transactions for payment processors tend to be on a percentage of purchase value basis. So in other words, the merchant acquirers make a percent of the total, and then as a percent of that percent, other network fees are added on, and it all flows through to the top lines, eventually the bottom lines of the ecosystem. So a $40 purchase on 2% merchant discount rate is less than a 2% on a $85 purchase. So that's the kind of difference that we're seeing here. So let me just break it out a little bit more. A debit card transaction tends in the US tend to be less than $50, around $40 or so. And that tends to be in place of cash for a variety of non-discretionary everyday purchases. Gas can be one of them. But as gas prices have increased from the 320 area a year ago to 435, 440 area now, some people may be switching to credit cards and saying, hey, I want that $85 bill for going to the gas station twice a month on my credit card so I can earn rewards now. And that's attractive, and that's a good reason to do it. But that 2% fee is going to be a lot more than the debit card, which is a flat rate. And even if I was using a credit card before for gas already, I'm making more now. So there's there's a multiplier effect for Visa for that percent of transactions that come specifically from the gas stations in the U.S. And
But you're talking about rewards and basically in an incentive based type dynamic. Is there an argument that, and it's interesting to me. I just got back from California. I was out there last week. I was in the San Diego area, and gas prices are sniffing $7 out there. So when we talk about the average cost of gas, I mean, it's like many things. It can be a very local type situation or dynamic or economic dynamic. Do you think I mean, is it just the reward incentives, or are people just because by virtue of the higher ticket size, they need to finance these purchases now?
well, the longer term, and you're touching on the where we were going in this conversation, where I was going in the conversation, is the longer term implications are unknown if the consumer can withstand that level of sticker shock for an extended period of time. So, in most parts of the country, most parts of the U.S., and California has some interesting dynamics about where they get their energy from, which I'm sure you know. So they have higher energy prices built into their cost of living index, if you will. If $7 were to hit the rest of the country, that would have that would be demand destruction. And whether it's debit or credit, there would just be less activity, I am convinced, whether it's driving or economic, because it's going to flow through to retail and other areas that are very important to keeping the economy going. So the answer is that is a one-off, but it's something to keep an eye on. And the longer the conflict continues in the Middle East and the higher the energy prices, there just has to be a threat of higher energy prices to have higher energy prices, right? Because it's priced off the spot, right? And it's all what people think is going to happen. And right now, we're very fortunate as a U.S. to be self-sufficient, but we see the disruptions that are going on over there, and that trickles back to how we price it, and it's all connected, and that is a negative. It's a headwind to the consumer if the economy deteriorates, or maybe that's the cause. There's a causational effect, an effect and causational relationship here. So, from my standpoint, and this is a little bit in a different area, but there has been very strong results last year in calendar 2025 from consumer spending in many categories, including things like restaurant delivery services, food delivery services. And even though someone orders a meal for $15 or $20, apparently they're willing to pay $30, $35, even $40 to have it delivered. And so there hasn't been any kind of elasticity examples there. So the demand was so strong, no one cared. They wanted it for convenience. I don't know if that's going to continue. So you have things like that. You have things like higher gas prices. I think that's something to watch. Those are metrics that I certainly pay attention to. Through 2025, all those metrics were very strong. But that was before we've had the most recent conflict.
So
Prices.
it may be a case then that it's a bit too early to attribute causation to volume increase to energy prices. It might not have actually flowed through into that volume spike yet.
So we're it's a biggest economy in the world. It's a big ship, and yes, the news flows faster than the impact, and so I would give it 6 months here before you have a better. We have a better handle. I think the 3 month window on the latest bump up in gas prices is too short of a window. And the longer this lasts, I think the worse it is. There's for me, in my opinion, that's only my opinion, nothing else. There are others out there that are saying, just to balance this conversation, the others that are out there saying that the consumer can handle a $5 a gallon ticket. I'm not so sure about that, but that's what others are saying. So just so you know, there's two sides of the argument that we may be able to grow right through this. And I hope that's the case. I really do.
And lastly, I assume you'll be looking out for the other networks when they report, in addition to some of the large issuers as well, to kind of parse out or tease out what's actually happening there, to come up to either validate or invalidate what you suspect is going on at this point.
Oh, no question. The space really offers a great opportunity for triangulation on certain big topic metrics like the ones that we're talking about. And if there was a ripple in the force, we would have heard about it, and particularly at this stage. But just to kind of tie this in a bow a little bit, for Visa, I got to call out the value-added services as well. The VAS had a very strong quarter, and these are all incremental services that are wrapped around transactions that aren't necessarily directly tied to the value of a transaction. So, and that had a very strong quarter. So I think it gives investors a reason to believe that the company's trying to balance their revenue streams into a more almost subscription-like service model. So it's a repeat, right? Most of the companies in the space have repeat models. Those that are in true subscription models tend to have a little bit more reliability in investors' mind. But I just thought I would call that out. And so this is a long time coming in billions of dollars invested on their part. They're starting to get it back, so it's working.